Hey everybody, welcome to our 160 unit seller finance deal that the Subto fund just acquired. I'm here with my partners, my friends, Ryan and Jamie. Ryan is our head of acquisitions at the Subto fund, and Jamie is our asset manager. Tons of experience, 10 times more experience than me. That's the reason why you build a fund. You assemble the Avengers of multifamily and you put them all together. We are standing at a 160 unit deal that we just acquired, and people have the opportunity, by the way, to invest and become partners with us. Just go to subtofund.com if you guys want to invest in a deal like this with us. Why is this even a good opportunity?
Well, you know, Pace, I mean, you could literally just turn around and look. So this was a seller that owned it. He built it, right? He built it in the 80s, owned it all the way through when we bought it.
Wow, that's like 50 years.
Yeah, I mean, he owned it forever. He was doing well, right? Didn't do much because it was throwing off some money. He was happy. But he was really missing the market because we looked at it and we said, okay, well, these rents, they're a good $300-400 below market. What we need to do is we're a value add fund. So we looked, it's brown. Brown in 2020s is
outdated.
It's outdated, right? So
it's not easy to go to your residents and say, hey guys, I know this guy owned this for 50 years and didn't improve anything, but welcome to the new world. Rents are higher. We're not going to renovate. We're not going to do anything. We're just going to add rents. We can't do that, right?
Yeah, we can't do that.
Well, I think that's one of the great things about Subto Fund is that community matters to us. So if we want to lift the rents, we want to improve the livability for the residents. We want to provide a better place for them to be. We want them to have better amenities, a nicer looking home, a place where they're happy to walk into every day.
Actually add value is what you're saying. So when Ryan says value add, it's a value add property. Ryan found this deal through an amazing relationships he's cultivated with a broker. And the story of this deal is really interesting. I'll tell it, you fill in the gaps if you don't mind. The deal is, Ryan has a great relationship with the broker. Broker says, hey, the seller's open. Ryan hits them up for seller finance. They were about to contract with us and they went a different route.
That's right.
Instead of Ryan being upset about it and groveling about it, Ryan said, hey, congratulations. If they don't perform, let us know, we're here. Guess what? They didn't perform. Ryan was there to save the day. We got under contract. What was our purchase price on this deal?
So we got into contract. It was whisper price, right? Brokers have a anticipation of value.
Okay.
It's called their whisper at 20 million. So I came in 19.5, and that's what works for our fund, right? That's the value I set at it. So came in, contracted for 19.5, and then got it under escrow and closed it.
Okay, 19.5. What did the seller want as a down payment?
So the seller wanted, basically he had some small debt in place, so we had to take care of that. That was like a 10-15% of the purchase price.
Okay.
All right. He also wanted a little bit of extra skin in the game from us, right? So this is a 35% down.
Okay,
right?
And 15% of it was basically paying off an old debt. The seller says, look, I've got an old remaining loan. Probably at some point he refinanced, pulled some cash out.
Exactly.
So he still has that debt and he goes, hey, I'm okay seller financing $15 million to you or whatever it is, but I'm not okay seller financing and letting you do Subto to my old debt. It would just make me feel better if you pay off the old debt and I'll seller finance the whole thing, basically a lot of it too.
Exactly.
Okay, so really his portion that the seller took was probably another 15% down on top of the 15% that we paid directly towards the debt.
Right.
Cool. Did the broker get paid out of the seller side or out of our side?
So the seller took care of the broker, he paid them, and basically it was a nominal fee to them, but the big benefit to us is that seller finance.
Cool. So the goal here is obviously not to hold this and keep that loan in place. The whole goal is one of probably three different strategies. One would be, let's improve the property, which means improve the value.
Right.
Go to a bank, do a refinance, pull our investors' capital out, potentially keep the asset. Another strategy would be, hey, let's improve value and sell this and roll our investors into the next deal. Have we determined what that strategy is going to be yet, or we're still kind of figuring out what the market will be when we decide to make an exit?
Yeah, I think it's really critical for us to make that decision after the value add has been essentially completed. Then we can test the market to understand, okay, what makes the most sense for our fund? Do we want to refi, like you just said, repay all of our investors their capital back and have them continue in this new debt structure? where they're still getting payments.
Guys, listen to this, okay? This is one of the coolest things about investing in a fund, is that what Ryan just said is, how much money how much are we raising for this particular deal?
The value add is going to cost $3 million just for the value add.
So guys, we're raising $3 million just for the value add. Let's forget about the purchase price. Let's just talk about the value add. If somebody came in and let's say they write a check for 100, 200, 300, we've got investors that are writing significant size checks. I'm the largest investor, by the way. I've got over $1 million of my own personal cash because I believe in the Subto fund so much. So I am somebody who, let's say, invests $250,000.
Right.
That money goes into the renovation, adds value for the residents. We add, obviously, income to our bottom line. The income to our bottom line raises the value of the property. We then make a determination at that point, what do we want to do? In that strategy, what Ryan just said is maybe the interest rates are really low in, let's say, 24 months, 36 months, whatever it may be, to the point where we can refinance, pull out our investors' money, give their investment back to them, and keep them in the deal even after they got their money back?
Right. So
that's insanity.
That's
like,
the beauty
think about
of the refi.
So cool.
Yeah. I mean, but also, I mean, we have the opportunity to raise the value of the property, and then if the market dictates that, hey, you know what, it's a perfect time to sell. There's others that want a more stable asset, and they're going to pay us for it.
Yep.
Well, we'll sell it to them, and then we can use everyone's capital, and we can either have them reinvest in our fund, which I think a lot of people would be interested in doing that because we just gave them a bunch of money.
Right. And you don't want to take the tax hit necessarily, and so you'd rather just let it compound and compound and compound, which is awesome.
Yeah.
But what you're saying is you're saying the market determines the exit strategy based on what other, maybe a big REIT or a higher level institutional buyer comes along and goes, wow, Jamie, your team, the whole asset management team did a great job cleaning this up, stabilizing, getting quality residents here, improving their way of life. We didn't want to do all of that work. So we're going to pay you a higher valuation for that property so we can avoid and skip the 3 years of the work that it takes to do that, and we'll just take over a higher performing asset at a higher price.
Yeah.
But we don't know what's going to happen there. And we also, what if interest rates go to 2%? Not saying they will. You'd probably go, guys, we should keep this thing. We can do a refinance at 2, 3, 4%, get all of our cash back, roll that into another deal, but keep the asset cash flowing for a long period of time. The market will determine what we do at that point, right?
That's right. I think one of the great things about this asset is that it was cash flowing when we acquired it. So in the first quarter, the end of 2023, we've already accumulated over $50,000 in cash that's distributable to the investors.
That's awesome.
So we're accumulating this now, and it's growing. And when we get to a point that we can send out returns, you know, that's passive income to the investors while they're still invested.
Okay, here's a question. If I'm spending $3 million on an asset like this, the guy, the seller who sold it to us was actually doing a really good job for the most part, right? His residents are relatively happy. It seems like this happens a lot in multifamily, is that the seller that owns it for 15, 20 years is like, I'd rather pull the cash flow out than reinvest it, which is where the opportunity was for us. So we're going to spend $3 million on the renovation here. What are the big things that we're doing at this property to add the value for these residents?
So there's a couple of things happening. Not only do you talk about adding value to the residents, but you have to look at the building itself, right? And the useful lives of the building. So although this doesn't seem like it adds value to the residents' life themselves, we did roofs, we did paint, we brought things up to compliance so that there were safety issues. So those things also add value to the property itself, the building envelopes, and then we go in and start doing things inside the person's apartment, in their home, to really make them happier and really build the community. So we're building the community for the resident, we're building the community for these buildings themselves, and we're improving the whole market that it's sitting in.
This morning when I stopped by the property, I got here a little bit early, and I spoke to two residents. One, younger guy, he said, I drove by this property ever since I was 3 years old, and it never changed. Yeah. And he's probably 35 years old. He's like, nothing changed at the property in 30 years. I found myself as a resident, and he goes, I welcome the increase of rent because I welcome the change. He's like, I'm happy to pay for that. I had another resident, a little bit older gentleman, his name is Ralph, Ralph was paying $600 3 years ago when he first became a resident, and he knows that his rent is being increased. Like $600 in today's market, it's
unheard of.
It's unheard of.
You can't find that.
He said that. He goes, look, while I don't love an increase of rent, the fact that you guys are going to increase the livability and the community aspect of this tells me that I'm okay with spending that extra money. Even though I'm on a fixed income, I want to have an improved life, and I appreciate what you guys are doing.
Right.
We actually have a list of residents who have asked to have their apartments renovated. Now, we're trying to add value to everyone though. So we are keeping what we're calling classic apartments at the most reasonable market rate.
Right.
That's a good point though, right? Market rate?
Market rate,
Right.
not below market.
We're not keeping the rents at what we bought them at.
We still brought it up to market.
Exactly.
Right? And what's happening is that people initially say, balk at that, right? And they say, I don't want to pay more. You're not giving me anything. I don't want to. And so they go out and they look at what else is out there. What else can I get for my money? First of all, they can't get anything for what they were originally paying.
Right.
And then for the same amount that we're raising that rental amount to, they're still not finding anything comparable.
Right.
And we're giving them more. So they're staying. And then there's a whole group of people asking for more. I want the full renovation. I want the top. I want to have everything you have to offer. And so we have a list, and we can't even keep up with it.
That's awesome.
Yeah.
So how long will the renovations go? Typically on a $3 million renovation, will that take a year? Will that take 2 years?
I would say 2 to 3 years.
Yeah.
And why would it be 2 to 3 years? Is it because we're waiting for certain residents to make a determination of whether I re-up my lease in the existing model, or I say, hey, I'm moving out, which allows us to renovate that, or B, I am extending in that model, which means you can't renovate? Are those types of things something that are at play right now?
Those things matter. So an apartment that doesn't have anybody living in it is generating vacancy, and that's vacancy loss, which means loss of revenue to your apartment, to your bottom line. So we have very high occupancy here. In fact, we just put a news article out that the Tucson MSA, the average occupancy is in the 89%. At our property right now, today, we're 96%, and we're leased to 98%.
Which means you have tenants or residents that are moving in that will bump it up. We already have commitments.
Correct.
That will bump it up to 98%.
Right. So the net present value
That's
of
probably
that,
as close to 100% as you can ever get.
pretty much, right. So the net present value of that dollar is more valuable to us than vacating the apartment, leaving it without revenue, and then doing the renovation and then bringing in another $100 or another $150. So we're doing it as people are choosing to move on somewhere else.
I love that. Okay, so the money, let's say I invest in the Subto fund. I know we're going to do another video on why you should invest in the Subto fund, what makes us different than other people. One, we do creative finance deals, right? The last 2 deals, seller finance, another one is assumption. We're doing creative finance deals, which is awesome. So you get to learn those things. 2, you're going to get a return. Where does the return come from? Does it come from cash flow?
Yes.
Does it come from, does the value of the property go up based on rents going up? Where do I make my money if I'm an investor?
All of those places.
All of the above. So not only are you going to get distributions as an investor from the existing and ongoing cash flow, but all of what we're doing right now is generating a higher sale price, right? So when we go to sell the property, there's going to be a big bump in the value, and that's where a big chunk of change comes back to all of our investors.
So what you're saying is multifamily is very different than single family in the sense that single family, I'm comping my value based on a house that's sold down the street, model match. In multifamily, we're valuing the property based on rent rates and my profitability.
Your income potential, right?
Income potential.
Yeah, commercial real estate is all about thinking about these properties like businesses, right? When you go to buy a business, what's the most important thing? The bottom line, right? So if it's not a profitable business, no one would want it.
That's right.
So,
you have to remember on your income expense statement, the income is the single largest line on that entire statement. And all of the numbers below it don't even add up to that one line. That is the most important thing.
Right.
Right? So what we're trying to do is bring the value to maximize that line.
Yeah.
And then we mitigate the expenses below by having improved systems. You know, new windows, lower utilities, right?
Jamie, that's a really good point, and this is something I want to bring up to Pace as well. So when we're looking at value add deals, like I just said, every property is a business. So if we're able to cut expenses, that generates higher
yield,
available capital to go back to our investors. So what is something that is in the operating expenses that it's in the news, it's everywhere across the nation, everyone's being hit, especially on commercial properties, is insurance.
Insurance, man.
Right? Okay, so
getting hammered by insurance.
Right. So Jamie made a good point about how the roofs, while we did the roofs and it doesn't generate higher rent, it actually does increase the value because we're able to go to our insurance carrier and say, hey, we did the roofs, we did the new windows, we improved the actual property itself, which might not give rent, but it allows us lower insurance.
Right.
So there's where part of your return comes from. If, let's say that I'm an investor, I give $100,000 to the Subto fund. Jamie, you and your team go and redo the roofs for 30 grand. You spend $70,000 on maybe retarring all of the streets, whatever that may be. You have less insurance costs, which then brings the value up. Essentially, that investment brought a 10x return. I'm not saying the investor will get a 10x return, but overall it works out to be you'll get a multiple on your money if all things go well, right?
Exactly. We have to remember there are distributions during the life of our fund, but it's a blend, right, of what you get at the end and what you're getting along the way to give you that final return.
So this is what we call IRR, right?
Exactly.
Correct.
Which, like, people in the single family world or wholesalers or fix and flippers, IRR might as well be like E equals MC squared. They have no idea what IRR stands for. Ryan, do you have a good description of what IRR means?
Yeah, it's basically the percentage return when you consider all cash flows. So it's your distributions. If it's a 5-year hold, right? It's a 5-year investment horizon.
Okay.
You're taking each one of those years, getting capital back, and the remaining year, getting a big chunk of that back. And then with the time value of money, you're discounting it all back to what that equals today.
Okay.
I know it's a pretty complex topic, but it's just everything that goes into the future. If I were to pay for it today, how much would I want to pay for that cash flow? Yeah,
so you've got, like in single family, what do we talk about a lot? We talk about cash on cash return. If I put $100,000 in, let's say I'm a hard money lender and I give somebody $100,000 that's fixing and flipping and I ask for a 12% return, my cash on cash return is 12%. It's very simple. It's just a very simple calculation. Multifamily is a lot more complex because you're taking depreciation into consideration, you're taking cash flow into consideration, you're taking the ultimate sales price of the asset into consideration, and when you get that big chunk of money back, you blend that over 5 years and you come up with a percentage.
Right.
Also, there's opportunity cost calculation to a certain degree, like the time value of money that goes into this. You might as well just build a rocket ship when you're talking about IRR. Like, it's scientific. Basically, it's the percentage return you receive over that 5-year horizon when you consider and blend all those things together.
Yeah. In fact, we are talking about perhaps not renovating every apartment, keeping a certain number of them classic to leave some meat on the bone at sale for the next buyer so that they can see their increase in their IRR.
Oh, that's a big deal. It's a really big deal to leave a little bit of meat on the bone for the next investor. Obviously, because the plan is to either exit or to refinance the deal, and you don't want to just strip out all the possibility here because then somebody's like, dude, you raised all the rents. I can't raise the rents on this thing for 3 more years.
That's right.
There's nothing I can do. All right, so guys, hopefully you guys understand where the deal came from. We talked about the purchase price, what the game plan is on this. If you guys are looking to deploy capital and be a partner with us on assets like this, we've got another 21 unit. We're going to do a video about that right down the road. And what's the rate on that assumption?
Oh gosh, so that was actually it's a little over 5%.
Okay, perfect.
5.1.
The market right now is a little over 7%. So we're getting properties at 2% below what you would be able to go out and get a loan for right now in this market. Plus, the debt structure nowadays, it's like you're having to put 40, 50% down on deals in order to get loans, even at 7 or 8%. So the way the Subto fund is structured is we kind of have an unfair advantage because Ryan and the team understand creative finance, and they're going in and creatively structuring deals, which yields a better return for our investors, and also, more importantly, mitigates our risk to what the Fed is doing and whatever everybody else is worried about, and why a lot of people fled multifamily the last couple of years are like, oh my gosh, how do I acquire this stuff? Well, you can see it. Ryan and the team are killing it. This is one of my most favorite assets we have in the portfolio. Like overall, we have 2,000 units roughly. This is my favorite one. Guys, invest@subtofund.com is the best email to reach our team, Brittany, head of investor relations, or go over to subtofund.com if you're an accredited investor. If you're not an accredited investor, that's okay too. Go to subtofundcf.com if you are a non-accredited investor. I think our average non-accredited investor is investing between $5,000 and $10,000 to get into a deal like this. So we'd love to have you as a partner. If you zoom around, you'll see a bunch of our partners are actually here. They're gonna have lunch with us today. I wanna see you at one of our assets hanging out. People flew in today to hang out at a property that they otherwise would never have had the opportunity in owning without Ryan, right. Jamie, everybody over at the Subto Fund is the backbone of everything that we're doing. We wanna see you as a partner on the next deal.
We want you to see your investment dollars at work, to see the great work that you're doing for this community.
You know what's cool is as I was walking around with Eric goes, I want to invest in the Subto fund. I go, why haven't you? He goes, I guess, if I put money in today, does that mean I'm diluted because I'm one of the later investors? I was like, absolutely not. Nope. We have a specific amount of.
It's not how our structure works.
It's not how the structure works. You're not diluted and you don't dilute the people beforehand. We've carved out percentage for a specific dollar amount until we fill that up. You get the same percentage as anybody else. And Eric's like, okay, so if I put in, let's say $100,000, where would my money go? I go, painting the fences, painting the things. Like your investment improves other people's lives. And that's what's so cool about getting on property, talking to the residents and seeing that your investment is actually changing somebody's life.
That's right.
Totally.
160 households' lives.
160 households' lives. So if you guys want to help change some people's lives, improve the livability of a residence like this, go to subtofund.com or subtofundcf.com, and we'll see you in another video about our 21 unit over in Tucson as well, right?
That's
Central
right.
Tucson.
Central Tucson. Later.